Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, the Primary Vision Frac spread count. And in this one, we're going to go through the spread count. What do we think about activations going through the rest of the summer? And then we're going to look at what happened with DUCs because the EIA just released for June. We're going to break that down a bit. Then we're going to go abroad, look at some of the product builds that we've seen and that we were talking about in the EIA show. And then we're just going to do a high-level look at some of the most recent U.S. data points, just because we had a lot that came out the past 2 days. And before we get into that, I'd always like to remind you, please like, share, subscribe. Your support is appreciated. And I just think that this is a funny chart to explain why it's so important to me, because I live in Nassau County. And as you can see, that cash buyers are dominating at 50%. So we need your support. I need your support so that I can afford to live in this terrible, terrible place. And yes, Long Island is horrendous. And as you can see, a lot of people from Long Island and Nassau County end up in West Palm, Naples, Northport, Florida, and Port St. Lucia. So it's really the New Yorkers that are just gunking up the whole system. So I do blame myself where I come from, but I just thought that was a funny backdrop in terms of just how insane some of these prices are when you look at what the 50% share of purchases made in cash is just unheard of. But it's the world we live in today. So now getting back to energy and where we sit. So when we look at the spread count, we had an increase of 4. So we had 4 spreads come. Last week was 238. We came into 242. And that's something when you just look at where are we seeing the activations, it's pretty broad. It's really not in one location. We had one in the Permian. We had several others in the Anadarko and in other parts of Texas. And then what we think is going to continue to happen is in the Williston. So when we look at growth, because our view is that really by the middle of August, we're going to have about another 10 to 15 spreads that have become active, getting us closer to that 250, 255 number. And then from that point, or to get that additional 20 or 30 spreads, as we go into September and October, we're really going to have to see a pickup in some of the orders and some of this horsepower getting repaired. Because when you look at what is still cold stacked, a lot of that has either been worked through to keep these active spreads running, or in terms of just things that need to be adjusted or tuned up. The biggest problem remains labor, which is why when we talked about additions, we kept saying it's going to be slow and measured, because it's going to take time to restructure, what is this crew going to look like? Who can I peel off and run this new crew with some of the new hires? So it's going to be at that very slow, kind of measured pace, but we're already at a point that is not only supporting current production, but actually helping us grow into what our target is of about 11.5 to 11.7 million barrels a day to close out the year, much closer to that 11.55, 11.6, but there is a chance that we could get that to that 11.7, especially just based on what some of the activity looks like. But this just gives you that backdrop in terms of kind of where we sit, where we think we're going. And speaking to kind of that measured move, here you can see the last 3 months going, a very slow, steady grind, 2-3 spreads. And one of the, what we sent out to clients today is that we expect, that 2 to 4 to continue on average to go up for the next, 4 to 6 weeks. We could get a quick move down, and it's only because we're looking at active spreads. So if somebody is going from one site to another, we're not going to count that as active. So again, we're trying to be as close to the mark as possible and trying to help you kind of plan, understanding where things are and where we're going to go from here. And now when we look at 242 spreads, this is the first time in a long time when we look going back to 2021 that we actually have over 200 oil spreads focused. So when you look at just where things are, the split still remains massively weighted towards the oil side, but we're starting to see some of these gas spreads come back, especially when you look at where the curve is and where things are going at this point in time. Now, we don't think that there's going to be a huge surge of gas activity. That is not what we were saying. But, we expect to see, that tick up in activity, because typically on a seasonal basis, this is when we start to see some of those new wells get drilled and get completed ahead of, some of the periods where you just can't really do as much activity when you look at West Virginia, Pennsylvania, especially as we go into the winter months. So this is just looking at the new release, when we look at what the EIA in terms of drilled wells, completed wells, and then our favorite drilled but uncompleted wells, or DUCs. So you can see the DUCs continue to draw down. We had another movement lower, and you can see it's pretty much across the board when we look at what's been done, where the Haynesville has actually seen an increase in DUCs. So that's when we talk about what's being drilled and then what we expect to be completed as we get closer to the winter months. But also remember, LNG prices are very strong abroad. Coal prices, aka thermal prices, very strong abroad. And that's going to keep some of this activity moving, especially in the Haynesville. So you can see that just we're drawing down, and now we want to call out and look at, where were we, where did we go, and where do we sit right now when we look at DUCs. So first, we're just going to look at that drilled but uncompleted well. So here you can see we're right back to where we were in 2018. So we had this massive buildup in DUC activity. There was a movement for the E&Ps in terms of parent-child. There was different types of moves in terms of trying to do infills. So now we've worked off some of that excess. You can see the steep drop off in terms of the excess overall as we went into a steeper lockdown in March and then through June, where we kept rigs on the sideline, but we started to bring back those frac spreads, which is what we were talking about, where in 2020, the goal was, let's minimize decline curves to 10 to 15%. And we got to about 13% decline curves. So that was able to stem the tide by the time we got into December of last year. And then we saw the acceleration through the end of the year. And now, as we keep talking about, rigs are going to start to pace faster then, and we're already seeing spuds pick up. The spud report was very bullish in terms of activity. And again, you're starting to see that climb back, which is what we've been talking about in terms of Q3. But the question's always going to come down to how much of this is useful. I see 6,252, but how many of them are actually viable? And the question and the problem is, it's really hard to gauge. But I think it's a fair assessment to say that there's 20 to 30% of these that will never see the light of day. It could be because they fell out of zone. They're in a location that just, even at this price, when we think about gas, when we think about NGLs, when we think about liquids in general and oil, it still doesn't make sense. So there is some of that where, at 100, game on, like all of this will start to come back. But there's some of that it's just, we're not going to get there. How much of it were child wells that if they were to complete them, there would be too much communication? So you have to factor in that there is a certain amount that is gone that just really can't be used, which is why we expect to see some of those rigs pick up. But what do rigs have a problem with? Labor. Like, labor is not just a frac spread thing or, at the retail restaurants, it's everywhere. And this is just another place, which is why we do expect to see one more DUC count drawdown. And then we think that we're going to get to a point where rigs are going to be able, not really to add, but just to stop the drawdown just based on where we're sitting. And this kind of gives you the backdrop of where. So the Bakken is the one that has seen the biggest drawdown, which is why we think that the Bakken's really going to have to see some sort of pickup if they want to maintain current production levels. Otherwise, that's the point that we think that we can see a fairly steep drop off. But then when you look at the Permian, the Permian is still well above where it was in 2018. And then in the Anadarko, same thing. So, and then when you look at the Eagle Ford is right back to where it was in 2018, which I think makes sense just because when you think about the Eagle Ford, they've been in, let's call it just production, manufacturing mode, and they just ran ahead. So now they're back to where they need to be. But the Permian still has some of that running room. Now, the problem is that run up in 18 into 19 is also some of those child wells. So even though there is, technically they're above 2018 levels, there's some of that may not make sense in this market, or just in general, just based on where it is. So again, it's not concerning. It's not like, oh, all of these ducks are gone. We're going to see this huge collapse in oil production. That's not true. That's not the case. But we're going to have to start to see these rigs pick back up at a slightly faster clip. But again, there's only so fast it can go. So that's why, seeing a very steady, 4, 5, 6 over this the next few weeks, I think makes a lot of sense compared to what we expect on the rigs on the completion side of those 2 to 4 on an average basis, just to try to work that out. So now when we look abroad, and we just want to touch on, so if you remember in the EIA show, some of this was because it was filmed on Thursday last week. A lot of these numbers were already in there. So here's where we have Singapore builds. We were expecting to get to about 49.5 to 50.5. So it was a little bit light, but we did get that build. That's what we think is going to continue to see an increase, especially on the middle and light distillate side. So resid is fairly flattish just based on what we're seeing, but it's middle and light that we think is going to see a bit of an acceleration. And then when we look at Europe, you can see that there was a nice healthy drawdown in gasoline and naphtha. Now the concern going forward on gasoline is the rise of COVID cases. And again, this is not saying that we have to worry about it. It's just the consumer has adjusted. We've started to see some restrictions get put back in the Middle East as well as in Europe. And we've actually started to see a drop in mobility and gasoline activity and driving activity in Europe in response to the spread of COVID. Because one of the things that we've been saying the whole time is, even without the government forcing something, people are going to naturally adjust. It's like, well, do I really need the additional exposure? Maybe I'll hold off going here. I'll wait a week or two. So it's just, you keep getting that punted to the right. And that's when you start seeing, well, I need it anyway, but I'm just going to order it online. And that's where we're starting to see some of that delta. So that's going to be one to watch, because we expect to see some of those gasoline builds pick back up. But gas oil did have a small build, jet fuel, something similar. But now we wanted to look a little bit deeper in terms of Asia, because one of the things that we've seen with the Asian backdrop, and Bloomberg actually just had an article on it, where Asian crude buying has been slow, and it remains slow, with several regions in China and Japan that have still yet to issue buy tenders. So spot differentials of when you look at Dubai have actually started to weaken above what we've seen from West Africa and the North Sea at this point, just because Asia is actually slowing more than even what I was expecting, just based on where we are. And even though the teapots and the Shandong refiners have still remained fairly active at about 74%, crude builds or just storage is just flat, and that's where you get this weighted back and forth, which is why then when you look at, well, they're still importing some oil, because there's still some of that in the offshore space, and they're still refining. So what's happening with product? Oh, they are building a lot of product. So when you look at fuel oil, you can see that in Shandong, we're actually at a 2021 high. And then when we go back through history over the last 5 years, we're at an all-time high on a seasonal level. So this is also slated to see more exports. So this is going to be that one to watch. But one of the big things, and for those that follow me on Twitter, I had a great interaction with someone who actually trades, for teapots out of Singapore. And when you look at what is happening with China's supertanker crude imports, you can see that we're coming back to that 5-year average, or 4-year average, really. So not too much to say one way or the other, but buying physical crude cargoes this month in Asia has slowed recently after the strong start, which is what we were saying was going to happen, which is why we saw some tightness in diffs, and then it immediately dropped back, because you had these weird spurts of buying coming from China. So one of the thing is, when we look at expectations were for a busy buying week in the spot market after the delay of official selling prices from the Middle East producers following what we all know with OPEC. But monthly tenders from major buyers such as China's mega refiner of Rongsheng, petrochemical, and Japan's Fuji Oil are yet to appear. Spot differentials of Middle Eastern crude grades such as Abu Dhabi's Murbain for September loadings are also easing after trading much higher month on month. So we're starting to see that, again, work forward, where not only are we seeing spot issues in July and August, excuse me, but they're already appearing in September, which is where, when you look at what Angola has announced, they've actually taken down their exports again, and based on what it looks like, they're opening up some room to see some of those deferrals kick back over, and trying to, again, free up some of those major rooms. So a major source of uncertainty for the market is the appetite for Chinese private refiners. Buying interest is yet to emerge following a tightening of crude import quotas by Beijing, and there's an expectation of a cut of 300,000 barrels per day. But again, there's also the state-owned refiners that are looking to kind of make some of that up. So even though 300 less going into teapots, we do expect some of that to flip over into the SOEs. So this is going to be that one to watch. And then, because we talk so much about grains in the Econ show on Thursday in segment 1, we just wanted to touch on Europe, because for those that have been following, there's been some devastating floods throughout Europe, which has created, unfortunately, loss of life, massive damage. So we're going to have to see what kind of damage that is done to the crops as well. But because of some of the water that has come through overall, some of the estimates have been taken up and bumped up on their wheat harvest side. But there's, because of the damage from this, there's a chance that some of this could be taken down. But when you look at 2020 versus 2021, even if it's taken lower, it's really just going to be right in line. So that's a net positive for yield. The question is always going to be, what is yield going to look like? There was a delay in planting, and then because of frost, now there's going to be delay in harvesting because of rains, because you can't run a tractor over saturated ground. For anyone who's ever try to drive something over a saturated field can attest to what happens to the tires. So that's where you're going to get some of that delay. So we're just going to take some time to see what the actual fallout will be. But now, when we look at some of the recent releases in the U.S., and again, we're going to go through this in more depth in the Econ show, but we just want to look at that high level. So the Empire Manufacturing actually had a big surprise, while Philly had a surprise lower. So the question is going to be, and we're going to get Kansas, we're going to get Dallas, so we're going to get other bellwethers to say, okay, well, the Empire Manufacturing side was a little high, or is Philly a little too low, or is it somewhere in the middle? And that's what we're going to have to look at. But right now, there's a bifurcation, and some of the recent data, or some of the data points, show that the Empire Manufacturing might be a bit high. But the benefit, or the good thing for both of them, they both have jobs and employees going higher, but they also have prices paid, prices received going up and staying up. And by staying up, we look at the expected 3 years forward, still remain elevated. Jobless claims, again, missing to the upside on estimates. And then the one thing that we're going to go through in more detail are import and export prices, which, as you can see, continue to go up month over month, which is, leading, again, coming back to the inflation story. Where are we going to see some of these pressure points as we continue to import some of this inflation? And then when we look at retail sales, we had a nice beat, but we also had a big increase in inflation expectations out of the University of Michigan, which is dampening some of that sentiment. And when you look at the Langer Consumer Comfort Index, you saw that come through again in a different way. But we'll just break some of this out in the next few minutes. So when we look at retail sales, June retail sales were stronger than expected at 0.6% month over month versus an expected negative 0.3%. Strong ex-auto sales of 1.3% versus 0.4% estimated. So there's also this delay when you look at just motor vehicles. And now, mind you, it's a big purchase, so big purchases take a lot of time. And this is going to be, it's always lumpy. This is just going to be extra lumpy now. But again, that's not something that we see reversing too much, because remember, in this past econ show, we talk about that conversion from durable goods, consumer goods into services. And I think that's really what you're starting to see accelerate as we go into June, and we see that continuing into July. But when you think about the pace of inflation, that's also going to mitigate some of that pace because services just don't go up in the same way, or at least on a dollar value side. So on a percentage basis, it could, but that's going to take a little bit more time to roll through. And then we're going to have that tailwind of increasing inflation going to be driven by those rents. Again, back to my very first slide of some of these housing prices and why we've seen some of those prices pushing higher. But this is going to be an interesting one, which we'll break down in more detail on Thursday. So then when you look at consumer-based inflation, strong rise, when you look at the expected over the next year is at 4.8%, which was initially at 4.1%, up 0.6 percentage points, highest since 2008. And then for the next 5 years, 2.9%. Again, just continuing to drift higher overall, which is being weighted against that Langer consumer index, but we'll talk about that in a minute. This is just one of the big ones when you think about inflation and what that next level of inflation looks like, and we're going to build. Now we're going to go backwards. So we talked about the Fed, the Fed numbers from Empire and Philly. Delivery times have gotten a little bit better, but they're starting to worsen again. You're starting to see some of that slowdown in pricing. And this is where it is, where prices are not really accelerating higher, but they're just staying bid in terms of where they are on the month over month, and then obviously the year over year. So when you look at year over year, June was down about 3.2%, but now we're up 11.2%. So again, you're getting that big shift to the upside. And more importantly, I think when you look at the import, is just where those imports are staying. Because clearly, when you look at exports have normalized a bit. They still are elevated year over year, not overly surprising. But that month over month still is sticking above that 1%, those 1% increases. But when you look at imports are the one that remain elevated. We talked about Chinese PPI. We're going to talk about Indian PPI again next week. And you're seeing, again, that acceleration and now those exports. Because when we talked about Chinese exports, we were saying that even though some of the tonnage was down, the value was up because they're pushing through some of those prices, which will show up here. So again, this is going to be imported in general. And then when we go further abroad, the spot rate for 40-foot shipping containers from China to U.S. hits a new high. So again, we continue to see these rates ratcheting up. And going back to 2015, you can see how fairly stable they are. And then obviously you had the 2020 adjustment, but then we went parabolic in 2021 as a lot of these inventories were taken to all-time lows, and now it's really struggling to get ahead, especially when you think of all of the issues in terms of getting containers back through the system, and when you continue to see the delays, which is again just keeping this elevated. And here's an interesting data point that actually dropped right before we started filming. So when you look at the bottlenecks, so we keep talking about the ports, we look at the West Coast. So right now, the LA is saying that they're going to move about 10.5 million TEUs, which would be a huge record. And here's where you can see how they're getting to this point. And we stopped making headwinds on some of this, because remember, January through May, California still had lockdown protocols. They still had COVID restrictions. So as those eased, you had some normalcy coming through, but it still wasn't enough to really clear some of this glut. Now there's additional problems. Union Pacific is going to halt movements from West Coast to ease congestion. So what does that mean? So Union Pacific is temporarily suspending shipments from U.S. West Coast ports to Chicago to ease congestion, the latest sign of strained supply chains amid the pandemic. The railroad will halt the movement of cargo and containers from port terminals, including those at these big complexes of LA and Long Beach, for about 7 days beginning Monday. That will allow it to clear out inland facilities. So this is actually going to get worse. Now remember, you need to also put backhaul. So you typically need to if you bring a container from Shanghai into LA, you need to send something back because you need the container back over there to come back to the US. And this is the issue. It's not just on the import side, but it's on the backhaul side, getting the container back to the boat, back on a boat, and then back across the sea. So this is just another data point just showing how some of this stress remains in the system. So what is this all doing? So when you think about personal finances, so the Langer index, not only was there a shift lower in comfort, but now people are starting to get more concerned about their personal finances. They're seeing inflation going up, but also what is happening, government transfers are going down. The unemployment benefits are starting to expire. And even though we're starting to get some of that replacement with the child care payments, this is starting to weigh as inflation is outpacing. Wages remain slow. We'll talk about wage increases or lack thereof next week based on some of the data that's been released. But these are some of those high-level components, which, again, is just eating into some of that demand. And that's where we continue to shake out. In our report to clients today, I did a deep dive. Unfortunately, as you can tell, as we're currently at about 25 minutes, I'm a bit long-winded. So I did about 15 pages on it, just breaking it down piece by piece, just looking at where are we going to close out the year when we look at some of these demand figures for refined products, for crude. So a lot of moving parts, always happy to talk. Hopefully you guys have a great weekend planned. It's going to be a little toasty here, but at least it won't be raining. So hopefully we'll get something to do outside. If you have any questions or if you want to see some of the stuff in real time, I talk about some of this on Twitter. Please follow me or ask questions there. Always happy to have the back and forth within the comments here as well. Thanks again for watching. We hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.